Okay guys, why do we need to value inventory? It's very important. So basically, we're going to start with some beginning amount in most cases. We're going to add additions to the already existing amount of inventory that we have. And that's going to give us the amount of inventory that we have available to us to sell throughout the accounting period. Okay, now remember, with the perpetual system, each time we make a purchase or a sale, we're updating the accounting records. With the periodic system, we wait until the very end of the accounting period, and then we split between ending inventory and cost of goods sold. With perpetual system, we're essentially doing this throughout the accounting period, but the idea is still the same. We've purchased items of inventory that we initially what is not sold is going to remain on our books, on our balance sheet, as an asset. It's going to show up in ending inventory as a current asset. The dollar amount associated with those items that are sold are going to appear on the income statement as cost of goods sold. Okay, and hopefully everything's okay with you, or you're okay with everything related to that from the previous chapter. But what if identical units of merchandise are acquired at different unit costs during a period? So we haven't really touched on this too much, and now is a good point to do this. So let's just say here we have, let's say these are all the same exact units of inventory, but the price is going to vary. And you know, this is going to happen in the real world as well, right? So suppliers are going to charge us different prices as time goes on. Maybe prices increase, and if we've been buying the same units of inventory, we need to know which ones we've sold when we make a sale, right? So if we were to make a sale and let's say we sold one unit, which unit did we sell? Did we sell the unit that we purchased on May 10th that cost us $9? Did we sell the unit that we purchased on May 18th for $1, or that cost us $13? Or did we sell the one we purchased on the 24th for $14? Which one? Okay, so let's talk about the different costing methods. So here's three different scenarios, right? Different things that we could have had. How do we determine which unit was sold? Well, if we sold the first unit that we purchased, that would mean that, and we're going to charge the same price regardless, right? So we have three different scenarios here. If we sold it for $20, let's say the first scenario here was that we sold the first one that came in. So we're looking at gross profit of $11. We sold it for $20, it cost us $9. We're looking at $11, and the remaining two items would remain in ending inventory, right? The 13 and the 14. Well, what if we pretend that the one that we sold was the one in the middle, right? So the second one that we purchased was $13. If that was the case, our gross profit would be $7, and the other two items of inventory would be what would remain in ending inventory and show up on our balance sheet. What if we had we assumed that the most expensive one, which was the last one that we purchased, was the first one that we sold? In that case, we have a gross profit of only $6, and the remaining two items are going to appear in ending inventory. So under all three of these assumptions, we're still dealing with $36 that was of inventory that was purchased, right? So we had a $9, a $13, and a $14. So now it's time for us to talk about FIFO, LIFO, and weighted average. So FIFO is the first of our inventory costing methods. The three that are typically used, like I said, are FIFO, which stands for first in, first out. That means that the first piece of inventory that we purchased or acquired is going to be the first that we sold, right? So we're assuming, hey, this was the first thing that came in, so it makes sense that it's the first to go out. Okay, so the oldest, cheaper items are going to be the ones, excuse me, let me get rid of that. The oldest, cheapest items are expensed first, and the newer, more expensive ones remain in ending inventory. So in this case, the $9 was expensed. It made its way to cost of goods sold, because remember, when we sell inventory, it moves from being on the balance sheet as an asset to making its way on through to cost of goods sold, where it's expensed. In this example, the remaining two items appear as ending inventory. Okay, and those are going to be on the balance sheet. So of the $36 cost of goods available, of the $36 of cost of goods available for sale, $9 went to cost of goods sold. Okay, under LIFO here, stands for last in, first out. So in this example, we assume that the last item that we purchased, this $14 item, is actually going to be the one that we sold. So remember, we only sold one unit. We're saying, hey, the last one that came in is going to be the first one that's going to go out. So we take this 20, we reduce it, the $20 of sales, we reduce it by the $14 cost of this item sold. That gives us a gross profit of $6. That leaves us only $22 left in merchandise inventory. Let's take a look at what FIFO had. FIFO, we had $27 in inventory and $9 in cost of goods sold for the total of $36. Here we have $14 in cost of goods sold and $22 left on the balance sheet, which also totals $36. Okay, so the newest, more costly items are expensed first, and the oldest, cheaper ones remain in ending inventory. So of the $36 cost of goods available for sale, $14 went to cost of goods sold. Well, what if you were thinking, instead of just saying the first one that came in should be the first one that went out, or the last one that came in should be the first one that went out? What if you say, hey, it makes sense that we take an average of the three or however many items of inventory that we have, and we use that for our unit inventory cost? Well, in this case, if we added these three guys together, which we know is $36, and divided it by 3, that would give us $12 for a unit cost. Okay, so if we're going to assume that, then that means that when we made that first sale, we're going to use the average of the 3, which will give us $12. So 20 minus 12 gives us a gross profit of 8. And the amount that remains on the balance sheet would be these two. We have 2 items left, and the average is $12. So 12 times 2 is 24. Okay, so the average here, the amount of ending inventory and the amount of gross profit, the amount of the cost of goods sold is going to be between the amounts we saw for FIFO and LIFO. So the weighted average method relies on the average unit cost to calculate the cost of units sold in ending inventory. And like I said, we're going to calculate that by dividing the total cost of goods available for sale by the total units available for sale. If the unit price stays constant, then any inventory costing method will yield the same result. So if the unit prices didn't vary, if these all stayed $9 per unit, weighted average, FIFO, LIFO, it would not matter. We would all end up with the same amount of merchandise inventory on the balance sheet as a current asset, and the same amount of cost of merchandise sold. However, in the book here, we're going to see that that's typically not the case, and many times in the real world that also is not the case. We're going to have different unit prices, and we need to be able to accurately trace those. So let's take a look at this graph here. So we've got FIFO. Look at the little picture here. So we have these goods that were purchased. It's kind of like a gumball machine, right? As you put more and more inventory in, the oldest items at the bottom are the first to come out. With LIFO, we put items in, and the last to come in are the first to come out. So you can end up having a lot of old inventory down here at the bottom that sits around for a long time, right? Like these cookies down here at the bottom are going to get stale after a while if we just kept replenishing and taking away from the top. In the weighted average, we put as we increase our inventory, an average of them is going to come out. So that'd be kind of like a smoothie, right? So we have them all mixed together and averaged out, all blended together. I also want to point out that up here at the top it says specific identification. This method could be used if the company sold a few easily identifiable items such as jewelry, fine art, an expensive automobile, etc. Right? So we can actually know which unit of inventory we sold. If it's a very expensive piece of jewelry, we're gonna know which one it was that was actually sold. Okay, and we wouldn't have to rely on one of these inventory costing methods that we use with indistinguishable units of inventory. Okay, so let's take a look now. It says inventory costing methods with a perpetual inventory system. For purposes of illustration, the data for item 127B are used as shown below. We'll examine the perpetual inventory system first. Okay, so we have, this is the same, these are all the exact same units of inventory. Okay, so we start out we're going to start out with a beginning amount of 100 units that cost us $20. Then we're going to sell 70 of them. We're going to purchase 80 more at a different dollar unit cost at 21. Then we're going to sell 40, we're going to sell 20 more, and at the end we're going to purchase 100 more at $22 per unit. So we can see here that the unit cost is going to change. Let's take a look at how we would work a problem like this. Okay, so at the top here, I put this on most of these slides here, so you can follow along here. So we have this information available to us while we're looking and seeing what would happen. And over here on the left-hand column here, we have a listing of what the journal entries would look like to enter these transactions into a perpetual inventory system. And notice with each sale, we're updating the amount of inventory, right? So let's take a look here. We're starting out on January 1st with a balance of 100 of these units at $20 per unit. That means we currently have a balance of $2,000 in this inventory account. Okay. First thing that happens here, it says we sold 70 units at $30 per unit. Okay, so the 70 at $30 per unit, remember the first step is to record the sales up here. Next step we have is we need to account for the impact that it's had on inventory. So we sold 70 units at $20 per unit and for a total cost of $1,400. So that means we initially had $2,000. Now we have to reduce it by the $1,400. So our balance at this point is $600. The next thing we're going to do is make a purchase of 80 units at $21 per unit. Now you can see here we have different layers, right? So we purchased 80 at $21 per unit for a total cost of $1,680. So now we have the 30. We have two different unit prices of inventory, and we keep these separate, right? We have the 30 from right here. We had 30 at $20 a piece, so we have that. We have 80 at $21 a piece. So we have a total of 110 units of inventory. However, one of them is a unit price of 21, and one of them is a unit price of 20. The next thing that's going to happen is we're going to make a sale. We're going to sell on the 22nd, we're going to sell 40 units at $30 per unit. Okay, so we sold 40 at $30 per unit, so we're going to account for the sale here. And then the next thing we need to do is we have to remember here we're using FIFO. That means the first in is the first out. So we sold 40 of them. Should we take the 40 and assume they were all $21 per unit? No, that would be incorrect. We assume that the first in or the first out. These 30 were in existence before these 80 at $21 came along, correct? So the first thing, these two total 40 units, right? So we sold 30 units at 20, and then the remaining 10 had to come from this second purchase that we made later at $21. So we sold 30 at 20, and then we sold 10 at 21. Okay, so the total cost of those is $810, and that means that hey, look, all of these are gone, all these 30 are gone, and 10 of this 80 is gone. That leaves us with 70 at $21, which is $1,470 is our total cost at this point. When I say total cost, I mean the current value that we would have assigned to inventory at this point. I also like to point out this column here, this is our inventory column, and this is our cost of merchandise sold column, right? So remember, we have to allocate between the two, between items that should appear on the balance sheet as an asset and those that have been sold, which should show as part of the cost of merchandise sold on the income statement. Okay, so that means the next step here is that we sold another 20 units at $30 per unit, right? So we sold 20 more, and remember at this point we had 70, all of our inventory before this sale, all we had was 70 units at $21 per unit. Okay, so we sold 20 at $21, so this is going to increase our cost of goods sold by $420. And that means that we only have, after selling the 20, that means we have 70 minus 20, it means we have 50 left at $21 per unit. So we have a total of $1,050 currently is the value of our inventory. Nextly, we're going to make a purchase of 100 units. $22 per unit is the cost. Okay, so we're going to purchase $2,200 more of inventory. So now we have the two categories. Remember, right before this purchase, we had 50 units at $21 per unit. So we have this category of that inventory right here. And we have this next category. We just purchased 100 units at $22, $2,200. Okay, see how it's important that we keep these splits, and when we make a sale, we can identify which units we sold. Do we sell the ones that cost us $20, $21, $22, etc.? It's important that we keep these properly categorized. And then lastly, when we get to the end here, we're able to, when we get to the end here, we're able to determine what amounts are cost of goods sold and what amount is our ending inventory. So if we look at and this makes sense if we think about it, we've been keeping a running tally. At this point, at the very end, we have these two categories, right? We have 100, sorry, the one is hidden behind this. We have 50 at 21 and 100 at 22. So the total amount of our ending inventory is 3,250. The total amount of cost of goods sold is the total of all these guys added up. If you add the 2630 plus the 3250, you get a total of 5,880. Okay? This represents the total amount. So we started with 2,000. If we add 2,000 plus this amount of purchases plus this amount of purchases, we get the same dollar amount, 5,880. Okay, so we had a total of $5,880 of inventory available for sale. Part of it went to cost of merchandise sold, and the remainder is going to appear on the balance sheet. Okay, guys, now we can take a look at LIFO, last in, first out. We're going to work this problem similarly to the way we did for FIFO, but let's take a look here. Let's get started, and you'll notice some changes as we work through it. Okay, so all the information up here is exactly the same. Same unit amounts, same dates of sale, and same cost, right? So the costs were increasing. So we're going to start out with 100 units at $20 per unit. We're starting out with $2,000 of inventory. We're going to have these two purchases, one on the 10th, one on the 30th. Okay, so we're going to have the same total amount. The 2,000 plus 1,680 plus 2,200 is going to give us 5,880. This plus this is also going to give us 5,880. The difference is the way it's split between cost of merchandise sold and split between cost of the ending inventory that's going to show up on the balance sheet. Okay, so let's take a look here as we work through this. So the first thing that took place is we're going to have a sale of 70 units at $30 per unit. Okay, so we had this $2,000 worth of inventory at $20 a piece. We sold 70 of them, so we only had one category to choose from at this point. So the entry is the same as it was under FIFO at this point. Next thing that happened was that we purchased $21 or 80 units at $21. So now we have the two categories. We have these inventory items that we had purchased first. These are the older ones. Then, more recently, we purchased these 80 units at $21. So we have our two categories. Next thing that takes place is we're going to make a sale of 40 units at $21 a piece. Now, how do we know that these are the $21 ones? Well, we're assuming the last in is the first out, right? So we sold 40. And these are the newer items here, right? The 30, these are the older items, and these are the newer ones. So last in, first out would dictate that the last ones in are the first ones out, right? So the last ones in were these $21 per unit ones. So we say, hey, 40 of those $21 unit ones need to make their way to cost of goods sold, and that leaves us with 40, the other half still remaining on the balance sheet as part of inventory. Okay, so the next thing we have here is we have another sale, 20 units And once again, the cost of the $30 has remained constant. And each time we make a sale, it's the same under either FIFO or LIFO. That what's going to be different is the amount that's going to be assigned to cost of goods sold, or the amount that's going to remain in inventory. So we sold 20 more. Well, after the last sale, we were left with this 40 units at $21 a unit, right? So now when we make another $20 sale, we assume, hey, these are still the more fresh. These were the latest ones that we have in our inventory. So we're going to assume that those are the ones that are sold. So we're going to sell 20 of those at $21 a unit. And so the 40 minus this 20 is going to leave us with the balance here of 20. So at this point, we have two different dollar amounts per unit. We have two different categories. The $20 units, we have 30 of them, and the $21 units, we have 20 of them. Okay, so at this point, if we were to add those two together, we have $1,020 in our ending inventory. The last step here is that we purchased 100 units at $22. So now look, we have three categories. We have these really old ones, $30, 30 units at $20. We have the $21 ones. We have 20 of them, and we have 22 of I'm sorry, I got the unit cost flip-flop there. We have 20 of the $21 ones and 100 of the $22 ones. These are the newest, these are older, and these are the oldest units. Okay? When we get to the very end here, we once again add these three up. 2,660. We add up any of these that appear in this column here. These are the amounts that are going to be sent to cost of goods sold. Okay, and they would have been sent with each transaction, right? So here we have $840. We can see we would have made the entry here, cost of merchandise sold, and we have a reduction to our inventory. Here we have 420. $420 is a reduction in our inventory and an increase in our cost of goods sold on the income statement. Now, we don't add all of these up to come up with our ending inventory amount that should appear on our balance sheet. We simply look at what remains at the end of the period. So we have 600 of these, $600 of these, $420 of these, $2,200 of these, for a total of $3,220. Once again, it's the total of these two guys together, 5,880, is equal to this 2,000 beginning amount plus the purchase here plus the purchase there. And notice under LIFO, our cost of merchandise sold is going to be higher than that under FIFO. Let's go back and take a look at the screen for FIFO. So remember, we had $2,660 of cost of merchandise sold under LIFO. It's lower here. This amount is higher under FIFO than it is under LIFO. Make sure you take a look at this screen. Feel free to pause it at this moment. I'm not going to read through all this just for time's sake.